One. This is Agriculture Today, and we start our Friday show with a grain market update. And as always, we're joined with K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Yes, thank you, Shelby.
And Dan, starting off our conversation how we normally do, discussing futures.
Yes, coming into harvest, of course, we're seeing prices for corn and for soybeans just moderating at what we now consider to be low levels. On yesterday's close, well, excuse me, during this week, we were trading around 4.90 to $5 for corn, and again, there have been times a year ago we were at $1 or $2 higher than that. But so for corn, we're kind of in the hanging around 4.90 to $5 for soybeans. About a little over. We've gotten to the place now with some support for the market that we're over 13 for November, and at least we have traded there this week, and uh, have kept trending higher in the soybean futures markets as well. Wheat markets for hard red, winter wheat. Uh, Again, we've had been on a long trend downward, have been trading here of late, more like 670, 680, again, $1 or so lower than where we've been. I think it's good to compare these recent trends with seasonal prices to see how prevalent seasonal lows have been, and when you look at the carrying charges in the futures, what are they indicating for what the market's anticipating for the rest of the year? Or for corn, uh, we normally have our lows in October, November, so we'd be consistent with that, and then tend to trend higher from that all the way in kind of a pretty consistent manner up to May and June. And again, that typically gives us some reward for storage of grains. Acknowledges some of the production risks that happen when we get out into the spring. But then once we get into May and June, with June being the typical high about the last 20 years in Kansas corn prices, then we tend to tail off into July and August. And so when you look at futures as they're projected for this coming year, you've got a little bit of a price rise, but not as much as the normal seasonal trends would indicate. So not telling farmers to store all their corn, et cetera, but it is interesting that corn futures right now are representing some increase, but they're below a typical seasonal average increase from now on into the spring. Really a pretty similar situation for soybeans. Typically have our lows right during October, right at the time we're talking about, as we're here in this about the middle of the month, and tend to see also prices run higher into June, and to hang around a little bit longer into July. So again, some reward for storage, although typically I don't know that people store soybeans quite as long as they do for corn. So you've got that type of situation. And although we see some carrying charges in the futures, again, they're less than we typically would see for a seasonal price rise going on into spring. So again, I'm not telling people necessarily to store their soybeans long term, but the market tends to be somewhat myopic, somewhat front loaded in its view of where prices are going, and when we do see over time a seasonal price rise, it's more the whole complex moving up or down together. So that's one thing to keep in mind. I would say for wheat is more of a challenge for us. The typical hard red winter wheat low has also come during October, especially November, and I'm not sure how I'd explain that, how I justify that, but that's just the reality of it. So over the last 20 years, the lowest price has come in November, just after we've seeded, and the highest price actually has come in February, and that makes sense, just with the a lot of the production uncertainty that's coming at that time. We're wondering how we'll break dormancy for hard red winter wheat, et cetera. But when you look at the pattern in the futures, we have again just a small amount of carry, not much at all, pretty much sideways, just a small amount higher. And again, at least from November on, we'd be what futures are representing now is less than the typical seasonal pattern of price rise on into February that we tend to see from at least November on into February. So something to watch for all of our ag producers. By the time we get to this point, this time of year, people's cash flow needs come into play, of course, and do they need to sell to generate income to pay off pay off any notes that we have that came into being because we had to buy crop inputs. So there are those issues, but once the upfront cash flow demands are met, then we find ourselves often in the storage mode and try to figure out how the markets would recover. I would say that as I look at that situation this year, Shelby, I think we are so dependent for price volatility and on the condition of crops in South America. There are some and those conditions are not just sterling right now. There are reports of dryness in parts of Argentina. It's affected some crops. Dryness in I believe the southern parts of Brazil, and so typically the market in October will say, well, there's a lot of time yet to come, et cetera. But we're not just starting off with that with full bore and no challenges yet. You'll have the major trade associations in South America and projecting record crops, et cetera. And they're not counting any negative weather events into their forecasts. So I guess it's a matter of what the market chooses to pay attention to, so I think that I would not just, if I were ag producers, I would not discount the amount of uncertainty and volatility that we could have going on into the spring, and that's not even accounting for all the geopolitical carryover impacts that we could have as well. So, I guess we're in the harvest mode for these crops and wondering where things will go. But I would just offer the idea of the typical seasonal patterns do tend to take us out of this once the harvest is done. We start focusing on usage and trying to account for any weather concerns in other major production areas of the world.
And Dan, something else that our agricultural producers could be paying attention to is ethanol prices and production.
Yeah, sure. Interesting to see the from a corn market perspective, what the bids are at ethanol plants now in Kansas relative to the rest of the nation, and also relative to where they were a year ago. Compared to a year ago, Kansas ethanol plant corn bids were averaging $7.77. That was the average, and there were higher than lower than that. Some at 8, some a little bit lower, less than that. But this year, and that was by far the highest in the nation. Next closest was Nebraska at 726. Also caught up in some of the dry weather maladies. Well, this year it turns out, at least for this week, that the average ethanol plant corn bid in Kansas is 494, and again, that's the highest in the nation. And the next highest being about 481 again in Nebraska, 480 in eastern Iowa. So I think with the advent of harvest this year, we've seen lower prices. That tends to be supportive of profitability in ethanol. Interesting to see that the trends for ethanol stocks have been actually trending lower, and that most of the time that's a good sign for that ethanol markets aren't overburdened, as tends to be supportive of prices. So we've come through this time with at least moderately okay ethanol prices and sideways to lower corn input prices, and that's generally a recipe for profitability in the ethanol industry.
And taking now a little bit of a deeper look into corn and soybeans and its tighter supplies.
Yes, I think the big issues now, as we sit having digested the October 12th WASDE report, going towards the November 9th WASDE and crop production reports, there's a question of where corn yields will go now. The one the USDA projected 173 bushels per acre, and a crop of just over 15 billion, about 15.1 billion bushels of corn. And in my own thinking, there's probably a 60% chance that they're right. We're getting more information, but we're not fully dug in with that being the final numbers. In my own thinking, there's about a 40% chance of some degree of lower corn yields coming in, and the pragmatic farmers in the audience would say, well, gosh, so he's saying 60% chance that it's right, 40% wrong. But there is a chance probably that corn yields could go lower. Let's say it went from 173 down to 172, very possible according to the USDA's projection of reliability on those numbers. Then you'd be down to 14.98 billion. Another bushel down, you'd be down to 14.89 to 14.8 if you go down to 170 bushels an acre. You do end up, if we end up in those scenarios with USDA's projection of 495, we start getting over $5, more like 5.15, 5.35, 5.55 if we go all the way to 170. But we have to get basically to 171 or below to actually start moving the ending stocks figure below 2 billion and putting ourselves in a lot more risky situation. And pretty similar question for soybeans. I think there's probably more risk of lower soybean yields than those early numbers, just because it's a little later developing crop, and stories we've heard, reports from the field, et cetera, that may or may not be right. So about a 55% chance that the USDA's projection of 49.6 bushels per acre is right. So approximately a 45% likelihood of something much lower than that. And so you end up at, if you drop that number down to say 48 or 47 bushels per acre, you do start going from the 1290 projection the USDA projected up to, you start adding, going from about 1290 to 1375 to 1475. If you go all the way to 47, then where do we go? That's really the question. And would tightness in the U.S. by itself lead the market to a strongly higher outcome with the South American crop still coming? I think that'll be driven by export demand. It's just how worried the rest of the world would be, and particularly China, in terms of potential short supplies. So interesting to watch, and we'll be watching closely, as well as all the rest of the ag markets, on November 9th to see what the USDA comes out and says.
Dan, I appreciate you taking the time to join us today and give us our grain market update for the week.
Thank you very much, Shelby. I appreciate it.
That was Kansas State University grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but we have more for you ahead.